Hi, welcome to Finance Masterclass. A derivative is a bet whether something will go up or something will go down. So what is this something? This something is nothing but underlying assets. Underlying assets like equity, bonds, gold, currency and many more. In a lot of countries apart from India, people also trade on weather derivatives. There are four types of derivatives: futures, forwards, options and swaps. In India, the most familiar which we know derivatives are futures and options. So who trades in futures and options? Is mostly, there are three types of players. One, speculators, second, arbitrageurs and third, hedgers. So what they do exactly? So they participate in the derivative market, and what happens in derivative is you are not buying the stock, but you are only betting on that stock whether Reliance will go up or Reliance will go down. So what benefits the derivative trader over here is, in equities we are only entitled to get only if the market goes up. So the probability is 1. But over here we can also earn money if the market goes down, and there is third probability if the market is flat. So it's one of the very interesting thing or interesting instrument which has come in last many years, which has evolved and which one should learn. The difference between equity and derivative. So what is equity? In equity market, you own a share for a short term or for a long term. But in derivative market, you just bet on a stock or on a particular index, whether it will go up or whether it will go down. In stock market, you have to pay the full amount of the stock, unless and until it's an intraday. But in delivery market, which 90-95% of Indians do, in that you have to pay the full amount. But in derivative, you don't have to pay full amount. You always pay some kind of margins like initial margin, maintenance margin and span margin. And in options, you pay a premium. And there is no concept of you paying a full amount. In stock market, in equities, it is less risky. In derivatives, if not learned well, it has more risk. In equity market, there are not several products as such, but there are only features such as intraday market. But in derivative, there are 4 different products, which is futures, forwards, options and swap. In this, forwards is mostly traded over the counter and the rest are traded on exchange. So these are the few differences between equities and derivatives. Between forwards and futures. In forwards, these are traded on over the counter. That means no exchange is involved. When I say no exchange, that means no NSE, no BSE has control over forward markets. But in futures, there is control of NSE, BSE in the futures market. So can I say that futures are more regulated and forwards are less regulated? Number 3, in futures, you don't have a counterparty risk, but in forwards, you have a counterparty risk. So when I say counterparty risk, means the person with whom you're dealing with might get defaulted. So if you buy or decide to bet on something with the other person, there are chances on the date when you want to exchange the cash flows, he might run away, or he might think that you might run away. So this causes a counterparty risk, which has been neglected in futures because of NSE, BSE and SEBI. So there are 2 instruments in options, as we all know, call and put. In call, we have 2 things, either you can buy a call or sell a call, and in put, we can buy a put or we can sell a put. So in which scenarios we buy call and in which scenarios we buy put? So let me explain to you. So when market is bullish, you have 2 options, whether you can buy a call or you can sell a put. And when market is bearish, you again have 2 options, you buy a put or you sell a call.